Welcome to episode 1862, and today we have Joseph Wang back on the show to talk about Central Banking 101 and his work at the Fed. This is likely the guest on any show who has the absolute record for trading more assets in dollar value than maybe anybody else in the world because he ran the trading desk at the Federal Reserve. And wow, they have got to be the largest investor in the world, right? They shouldn't be, but hey, it's not a perfect world. We have a centrally planned economy. We have what we have. And as you know, my philosophy is always align your interest with these big powers. The two most powerful forces the human race has ever known: governments and central banks. Okay, before we get to Joseph, let me share a couple of things with you here. First of all, housing inventory. It's going up, up. It's going up. Okay, so we have a 6.2% increase from last week. This is pretty significant. I've got some data here from our friends at Altos, and we are getting Mike back on the show, hopefully soon. He was on before, and we'll take a deeper dive and get some of his opinions and thoughts on these numbers. But right now, we stand at an inventory that is still overall historically very low, but it is trending up with these higher interest rates. 444,000 homes for sale in the US in terms of the 7-day average. But when you look at the 90-day average, and you can see that on the chart if you're watching on video, by the way, if you're listening to the podcast, it's always a great idea to simply refer to the YouTube so you can see the video and see the charts and graphs. And actually, I got one more thing for you. I didn't mention this, but I'm going to let you in on a little insider thing. We are really trying to do a much better job of sharing our slide decks with you. And, I've been on a whole bunch of speaking engagements lately. For every speaking engagement, I update my slides, I tweak them, I talk about different stuff, I take slides out, I put new slides in. And if you are not one of our sleazy competitors who is stealing our ideas, yeah, that means you, sleazy competitors out there, then you are welcome to go and download several of my slide decks at jasonhartman.com/slides. And I'm sure some of you sleazy competitors will fake that. And don't worry, I'll see when you're out there using my stuff and not providing proper attribution. The world is full of sleazy tricksters, isn't it, folks? There's just too many of them. But anyway, go to jasonhartman.com/slides and you can get some of my recent slide decks there for you. It won't contain this, but this may show up in there someday. Anyway, the 90-day average, though, in terms of inventory levels, 330,000 homes. So you can definitely see how inventory is increasing, but we are still way below the necessary inventory to have just a normal market. We're way below it. We still need to see inventory increase by, and I used to say 300 to 500%, but I'm going to change that now because inventory has increased. We need to see inventory increase by about 250 to 400% to be at normal levels. And that only gets us to normal. It doesn't get us to a buyer's market or a down market. Supply is still extremely low, but it is moving up and we'll continue to watch it. However, remember, I've taught you about how it depends on the price range. And when you segment by price, this gets really interesting. So let's take a look at this chart, and you can see that the higher priced homes, when you look at higher priced homes, okay, don't worry about lot size or square footage or any of that too much. I just want you to look over here at price, okay? The median price, when you segment it in the marketplace into 4 parts, the median price of $180,000. Now remember, median and average are different things. And I've always kind of wondered if it's better to use the median price than the average price. The statisticians like the median. I'm not so convinced that that's the right way to do it, because all you do is you look at all the prices and you pick the one in the middle. You got the median price. I don't know. Maybe they should average them out, but of course they're concerned about, not having weighted averages. So if one super high-end home or one super cheap home is on the market, then it's going to skew everything. But when you divide it into the 4 quarter segments here, I'm not so sure. But whatever, it is what it is, okay? So median price of $180,000, you can see that you had 22,480 new homes hit the market, but the number absorbed was 23,180. That means more properties are being absorbed, in other words, purchased. That's the drain in the bottom of the sink. Remember, I showed you that before, that graphic. And then are coming on the market or for sale, right? So this inventory is declining. That's the important point. That's the important point. Did you hear that? The inventory of the entry-level homes is declining. Well, the broad overall inventory of all homes for sale is increasing. That's why it's very important to peel back the layers of the onion so you know what's really going on. Because, of course, if you're listening to this show, you're probably an investor or you're interested in investing. And, of course, the properties you're investing in are these entry-level homes. Now, remember, these are nationwide numbers. So, again, you got to allow for some price differences there. Now, if you go to the next quartile, and we see the median price of $370,000. Of course, for those of you watching, I'm rounding off. It's $369,900, but I'm rounding off. Okay. You see that we added 24,628 houses to the market and absorbed 22,338. And look at these days on market numbers, folks. They are extremely low. Only 21 days on market. This is still a market suffering from a massive inventory shortage. Increasing a little, but very short. But then when you get to the higher end homes, you see that becomes more imbalanced in favor of the buyer, because a lot more homes are coming on the market than are being absorbed. In other words, those are being absorbed more slowly, but they're being listed more quickly. I hope this helps you really realize that this whole inventory picture for investment properties, for rental property price ranges, there is still a massive supply shortage, and the inventory is declining, not increasing, declining, at least for now. It's subject to change without notice. Well, actually, you will get notice, because you'll be following the show, and hopefully you'll be watching on YouTube so you can see the video. You'll download the slide decks at jasonhartman.com/slides, and you will be, of course, listening to the Creating Wealth podcast. Okay, now I have an announcement. We have our weekly giveaway of 2 $50 Amazon gift cards. And by the way, I want to show you in just a moment here, after we do this, about how the whole economy is smoke and mirrors. It's built on a house of cards. We're going to see that in just a moment before we get to our guest. But the announcement about this giveaway, this weekly giveaway that we've been running for a long time, is, hey, we're getting bored. Yeah, we're getting bored. So this will be the last week of this giveaway for a little while. We're going to put it on pause here because, hey, you're costing us a lot of money giving away $100 a week. Nah, that's not the problem. We're just going to design something new for you to keep the interest, keep you stimulated and going. And it might involve some other platforms and other things, okay? But the winners for last week here for the YouTube comments, just go on YouTube, make any comment, is Politicracked Podcast. Okay, you are a winner for your comment on the 2.999er here. Feel incredibly, okay, so anyway, yeah, whatever that says. I can't read it behind my screen. And then we have got Isaac Wells, who won for the Apple Podcast Review. Go, Jason. Thanks for all the knowledge you've shared since the start of the pandemic. Well, hey, I was doing it way before then, so be sure you listen to the older shows and be sure you catch all our Flashback Fridays. Do not miss Flashback Friday, folks. Well, if you do miss it at your own peril, because those who do not have a sense of history are doomed to repeat it. That's why you must listen to Flashback Friday. Okay, very important. Anyway, congratulations. Go to jasonhartman.com/ask and claim your prize. jasonhartman.com/ask. So I have proof again that the economy is built on smoke and mirrors, on a house of cards. Check this out. This comes to us from our prior show guest, Richard Duncan, who's been on several times. And this chart is fascinating. He just published it. It is total credit in millions in the US from 1951 to 2022. And what this shows is that we have now 90 trillion, that's with a T, $90 trillion of outstanding credit. Now remember, in fractional reserve lending, fractional reserve banking, in the smoke and mirrors economy we have, you've heard me say it a zillion times on prior episodes, that it is hard to get your head around this, but it is very important to understand that money is lent into existence. Money is lent into existence. With the absolutely crackpot setup we have, that's how money is created. So when you create more credit, you create more money. And technically, we shouldn't even call it money. We should call it currency, because that's what it is. It's not money. In my thinking, money is something that has intrinsic value. Fiat currency does not have intrinsic value. It does have value, especially US dollars, because it is backed by the largest military the human race has ever known, and a whole bunch of other things that I've explained on prior episodes. But just looking at this chart, fathom the idea that in just 58 years, there has been a 90-fold increase in credit. A 90-fold. We went from $1 trillion to $90 trillion in credit. Now, the doom and gloomers, the Peter Schiffs, the Harry Dents, the other survivalist type people, they will all say, this is the end of the world. It's all going to crash. And they might be right. But so far, they've been extremely wrong. Why? Why is that? Because nobody knows how much credit we can withstand. Nobody knows how much deficit we can withstand, or how much national debt we can withstand. Look, the question is always, hey, you know the question. Compared to what? That is always the question. The Jason Hartman question, as you've dubbed it. Thank you for dubbing it my question. I only wish I actually invented it. But compared to what? Compared to what is the question? Compared to we've never been here before. That's one thing to compare it to. And we don't know, maybe we can withstand $300 trillion in credit, maybe $700 trillion in credit. Nobody knows the answer because we've never been here before. But then the other compared to what question is compared to what other country? Compared to what other country? Who's better off? We're the only one with the world's reserve currency here in the States. And I know we've got an international audience with listeners. Thank you, listeners, for listening in 189 countries worldwide. I'm so grateful that you're all listening to this. And you might think, well, Jason, Talk about some of these other countries, not just the US. Well, I certainly talk about the big ones. But look, the big ones have so much sway in the world economy that that's what matters. That's what you got to talk about. So the US is number one, China's number two, Japan's number three, et cetera, et cetera. You go down the list, right? But these are the biggest economies that are pushing most of the activity around and most of the, you could call it toxic debt, right? But nobody knows how far it can go. And, everybody was sounding the alarm bells when the debt to GDP ratio was 30%, and then 50% and 60% and 70% and 100%. We blew past all of that, and it's still moving. Japan's debt to GDP is what, like 230%? And, it has suffered, but it's got the demographic problem. It's got the people just opting out of life problem, especially men in Japan. Really sad story, but nobody knows how far it can go. There is no answer. There is no compared to what. So that's the thing I'd encourage you to keep in mind when you listen to the people talking about how the sky is falling, because they don't know at what number the sky falls. None of them know. Nobody knows that answer. This could be kicked down the road for another 50 years, another 100 years. Nobody knows. Maybe another millennia. Who knows? The answer is nobody knows.